right, let's take a look at the rules of debits and credits. So we start with the accounting equation. Assets equals liabilities plus owner's equity. So if we were to break this out into debits and credits, our asset side has a natural debit balance equals liabilities plus owner's equity, which have a natural credit balance. So the two golden rules of accounting: assets equals liabilities plus owner's equity, and debits equal credits. Assets generally have a natural debit balance. Liabilities and owner's equity have a natural credit balance. Which means that when assets go up, it's a debit. Assets go down, it's a credit. Liabilities, when liabilities go up, it's a credit because you see a credit balance. When liabilities go down, it's a debit. And if we break out our owner's equity into capital, revenues, and expenses, so when capital goes up, for instance, when the owner contributes capital to the business, that would be a credit. And then the inverse would be a debit. We know revenue increases owner's equity. So we know that owner's equity goes up with a credit balance. A credit balance increases owner's equity. We know revenue increases owner's equity. So when revenue goes up, revenue would be a credit. When revenue goes down, it's a debit. And then expenses, we know, decrease owner's equity. So if credits increase owner's equity, debits must decrease owner's equity. So when expenses go up, it's a debit. And when expenses go down, it's a credit. So these are our general rules of debits and credits. So let's look at some transactions. So our first one, so owner invests $500 cash in the business. Owner invests $500 cash in the business. So the two accounts we know that we're going to be dealing with here, owner invests, owner investment, that's going to be in the account called capital. And then $500 cash. So the second account, we're going to be dealing with cash. So the capital account, is our capital account going up or down? Well, we're contributing capital to the business, so our capital goes up. Our cash asset, we're going to have $500 infused or $500 incoming in the business, so that means our cash asset goes up. So capital is part of owner's equity, and cash is an asset. So when owner's equity goes up, it's a credit. And when assets go up, as we could see with our assets go up, it's a debit. So in this transaction where the owner invests $500 cash in the business, we're going to debit cash, credit capital. So if we were to put that in a journalized form, we have our debit to cash, one indent forward, we credit capital for $500. All right, so let's look at another transaction. In this transaction, we're going to say we purchase $100 of supplies on account. $100 of supplies on account. So supplies is going to be one of our accounts. And then on account, we're purchasing on account. So that's accounts payable. We know that supplies is an asset because it's something we own and it has future value. And we know accounts payable is a liability because it's a debt. It's a debt the business owns. So we have supplies incoming. So that means our assets are going up. We're acquiring supplies. We're purchasing them on account, so we're taking on some new debt. So that means our liability will go up as well. So when assets go up, we know assets go up as a debit. And then we know when liabilities go up, it's a credit. So our entry would be to debit supplies, and then credit accounts payable, and I abbreviated AP for the sake of space, for $100. All right. So let's look at another transaction. So let's say in this transaction, we paid off $75 on account. So this is just a crazy way of saying we paid off some debt. We paid off $75 of our debts. So what did we use to pay off our debts with? We used cash. And what did we pay off? We paid off accounts payable. We paid off debts. So we know cash is an asset because cash is something we own that has future economic value. And we know accounts payable is a liability because it's a debt. So we're paying money. Cash is going out. So when cash goes out, cash is going down. We're paying off debt. When we pay off debt, our debt goes down. Assets go down, it's a credit. Liabilities go down, it's a debit. So if we were to journalize, debit accounts payable, credit cash for $75. So with these transactions, we take our work we already know how to do with the accounting equation, identify our two accounts that are impacted, in this case cash and accounts payable. Determine whether they're assets, liabilities, or owner's equity. Determine whether they're going up or down. And then finally apply our debits and credit rules to these transactions, which allows us to get to the final step, which would be to journalize. Let's have everybody take a look, and please reach out with any questions.